Liquidity is not the only measure that affects asset prices, but certainly in the near term. Let's say a typical equity, right? How it performs over 5 years will largely depend on its fundamentals, but how it performs quarter by quarter will largely depend on liquidity and sentiment. And so we have kind of a neutral liquidity situation overall, most likely. I do have concerns around the second half of the year because at that point, if the TGA is drawn down and the Fed's still doing quantitative tightening, if there is some sort of debt ceiling resolution, which you'd have to have at some point, and then the Treasury starts refilling its cash account, that's sucking liquidity out of the system while the Fed is also still doing quantitative tightening. That could be a double negative whammy for liquidity, and so I wouldn't be surprised to see pain ahead.
Indeed, asset prices are generally influenced by macroeconomic factors, such as the key fiscal and monetary policies of major economies around the world. A bloodbath caused by contractionary policies and massive price gains caused by expansionary policies would affect Bitcoin and other cryptocurrencies just as much as any other asset. Popular macro analyst Lyn Alden recently provided an important update on her macro outlook and how shifting economic conditions may impact asset prices in 2023 and beyond, and she noted that several macroeconomic issues that impacted asset prices over the past year have yet to be completely resolved. Alden elaborated on the state of liquidity in the United States and what it could mean for asset prices during an interview with Xerox Research that aired earlier in the week.
Yeah, I think the long short of it is that, obviously there was massive fiscal stimulus in 2020, 2021, huge burst of broad money around the world with a lag that started to translate into higher prices on aggregate because there was not a uptick in production of goods and services, but there was an uptick in purchasing power of basically at least currency units. And so you had a lot of people going out and buying things and not necessarily a lot available. When you add things like war, geopolitical risks, rising tensions between China and the United States, basically some of this globalization, maybe not going away, but just kind of, not growing the way it was, maybe even pulling back to a certain degree, there's generally more inflationary pressures. And so 2022 was a year of central banks trying to fight back, trying to rein in credit creation, trying to get the air out of excess asset prices, basically increasing the cost of capital so that most valuations compress, a lot of malinvestment gets kind of pushed out of the system. And right now we're kind of at an inflection point here in 2023 because fiscal policy is still very accommodative. There's still very large deficits kind of flowing into the economy, but central banks are still being kind of aggressive. And I think, one of the risks of a policy mistake is that normally higher interest rates are a way to reduce money creation from bank lending, right? So when we think of the 1970s inflation, that was because there was a demographics boom and banks were lending. They were creating more and more fractional reserve money, and so tighter monetary conditions were a way to try to rein that in. Whereas when, for example, we look back at the 1940s inflation, fewer people are familiar with that time frame. You had inflation that was just as high as the 70s, but that was not due to bank lending. That was due to fiscal spending, obviously on the war. But then that war spending would go back into the economy, and so you had a big increase in the amount of money in the system, and you got much higher overall inflation, even though banks weren't lending. And basically, we have kind of a 1940 style inflation so far this decade, but central banks are kind of treating it as though it's like a 1970s inflation. And I think this is bound to cause problems in the years ahead. I think if I were to say it overall, I think right now we're in a disinflationary period within what is at risk of being a longer term inflationary decade on average. I think we could get more waves of inflation before this decade is done. But liquidity is not the only measure that affects asset prices, but certainly in the near term. Let's say a typical equity, right? How it performs over 5 years will largely depend on its fundamentals, but how it performs quarter by quarter will largely depend on liquidity and sentiment. And the same is true for macro assets, gold, Bitcoin, certainly other cryptos as well. And so these things are going to bounce around in large part based on liquidity. And that like a combined domestic liquidity indicator is a pretty good one. And there's three main components, and so we can kind of outline what's going to happen with all three of them, right? So the Fed balance sheet is anticipated to keep going down for now. That's basically the Fed's intention to keep reducing their balance sheet, which is negative for liquidity, right? So that's kind of the background direction. Then you have the Treasury General Account. That's basically the Treasury's cash account with the Fed. And this one is inverse, where when it draws down, that's actually good for liquidity. That's pushing money out into the system. Whereas when it increases, it's bad for liquidity because basically it's sucking money out of the system and then just holding it there in this void that's not actually flowing into anything. And the Treasury targets to have around $500 billion just sitting in its cash account. But one of the things that happens during debt ceiling impasse is if it goes all the way to the end, is that one of the things they do when they can't issue more debt is they can draw down their cash account to keep paying their bills until they're able to issue more debt. And so, ironically, in the lead up to a debt ceiling, that could be positive for liquidity because that all that cash is kind of going out into the economy and it's not being refilled. And so, actually, since basically Q4, that has kind of been happening. It's been offsetting some of the Fed's quantitative tightening. So that's been pretty neutral. And the third component is reverse repo activity, which is more esoteric, but essentially that's just another big liquidity void that's been built over the past couple years. And that's been showing signs of flattening and rolling over. And if that does start going down, that's generally positive for liquidity as well. So the way I would describe it is that until, assuming the debt ceiling goes down to the last hour, right? So assuming it goes into the summer, assuming that the Treasury's not able to issue net new debt, we're probably going to see a TGA draw down. And that's going to offset some of what we're seeing in the Fed's quantitative tightening. So we have kind of a neutral liquidity situation overall, most likely. I do have concerns around the second half of the year because at that point, if the TGA is drawn down and the Fed's still doing quantitative tightening, if there is some sort of debt ceiling resolution, which you'd have to have at some point, and then the Treasury starts refilling its cash account, that's sucking liquidity out of the system while the Fed is also still doing quantitative tightening. That could be a double negative whammy for liquidity, and so I wouldn't be surprised to see pain ahead. But in order to get to that point, we first have to see how long this debt ceiling impasse goes and how far that TGA cash account does draw down. So that's kind of the flexible framework I'm working with this year, but it's subject to all sorts of change on a kind of a month by month basis. So the Fed has been decelerating their rate hikes, but they're still doing quantitative tightening at their prior pace. And we have seen disinflation in a number of inflation measures. Some of them rolled over earlier than others, but now there's a broad enough rolling over that Powell has been basically a little bit more confident in his assertions around inflation heading down, while still reiterating that they want to remain tight for longer. This, I think, ties into some of the prior issues I said before, where they're kind of, he's actually cited the 1970s and Volcker a number of times, which is kind of concerning because it's more like 1940s inflation, and he's not really citing that period. It kind of, I think, shows somewhat of a maybe a recency bias in that regard, basically around kind of the sources of money creation. The Fed also, when they were talking about inflation being transitory or not being too concerned about inflation prior to this all happening, I also think they were showing a misunderstanding of money creation, which is kind of concerning from the biggest central bank in the world. It's not exactly what you want to see. So my overall view is that he's getting a little bit less hawkish, but he's still reiterating that they're going to stay tighter for longer. And I think they're essentially going to try to stay somewhat tight until they break something, right? Until you have kind of like illiquidity in the Treasury market or you have outright recession, I think they're probably going to stay somewhat tight. Now that is kind of complicated because if you look out long enough, that can actually be inflationary. If you have high interest rates on very high public debt levels and you keep running deficits anyway, that actually pours more and more money into the economy. Basically, the federal deficit is a surplus for the private sector, which sounds good unless it's money creation. It's inflationary over the long arc of time, but it does spell kind of risks. I think kind of for the rest of this year. I do think that the market is. I'm not betting on a soft landing. Let's put it like that. I think either you're going to get kind of an inflationary breakout or you're going to get a recession that temporarily quells inflation. And that seems to be the way that most economic indicators are pointing to by either the end of this year or early next year.
How do you feel about Lyn Alden's crucial macro outlook for the years 2023 and beyond? Inflationary 10 years in the United States is something she and other prominent economists have forecast before. Is that where you see us going? How do you anticipate Bitcoin and the other major cryptocurrencies faring in this setting? Your thoughts and feedback are welcome down below.